So Canada's GDP grew again in Q2 of this year, but it seems like the banks and financial institutions in Canada aren't really buying this growth anymore. Today's release from Desjardins says that Canada's GDP beat the Bank of Canada's forecast, but is not likely to happen again in Q3. And they also published this excellent graphic that shows that government spending was the primary driver of real GDP growth in Q2 of 2024. RBC Economics says that growth was higher than expected in Q2, but the details are soft. And most notably, they state here that residential investment, which is real estate commissions and home renovations, dropped 7.3% on a quarterly basis, which was the second quarter in a row. And they also show here how GDP per capita, which seems to be the primary metric that people are focusing on as a quality of living or standard of living metric in Canada, dropped again for another quarter. And they only show 6 quarters in this visual, but it's actually been 9 quarters, so over 2 years of decline in GDP per capita in Canada. And this GDP per capita metric is becoming more important to Canadians because everybody's feeling the impact of a contracting economy on a per person basis, simply because our population is growing significantly faster than our GDP, which means that the amount of GDP that each person gets in Canada is shrinking to the point where basically if you draw a line to where we are in present day and compare it to where we would be in the past, we've basically seen no economic growth since 2016 or 2017 on a per person basis in Canada. Now, what makes this even more interesting is if you return to what Desjardins had to say about the public sector spending going up and public sector job creation going up and propping up the GDP. There are kind of 2 ways the government can really keep GDP inflated. Number one is by increasing the number of people, which has been referred to as quantitative peopling in countries like Canada and Australia. And then the other one is they can spend a lot of money and create a lot of jobs. Given that the government is making significant moves to limit the number of international students and scale back the LMIA, Labor Market Impact Assessment Program for temporary foreign workers, it would be reasonable to expect that we're going to keep seeing more and more expenditure from the government in an effort to continue to prop up GDP growth in Canada. I think that this is kind of reckless and it's going to have some serious consequences, but we've seen many of the politicians in the current government cheering on GDP in Canada and completely ignoring what matters to Canadians as individuals, which is the GDP per person or per capita. So my expectation here is that government spending will continue to drive real GDP growth in Canada, and we still won't see growth in a GDP per capita basis because population will likely continue to outgrow GDP. What does this mean for Canadians? It means that our country is getting poorer on an individual basis. We are losing money. We are losing what we are able to extract from the economy because there are more people trying to take less money out of the same economy. On a real estate basis, one of the biggest ways that I think that this materializes is when we look at what people are supposed to spend their income on, 30 to 50% of their income goes to housing. And so you're going to see significant contractions in how much money Canadians can spend. Rents and prices will have a very hard time growing in an economy where per person expenses are shrinking unless we start to see continuing amalgamations of households, which we are seeing in Canada with roommates being the fastest growing household type in Canada.